Imagine working for 20, 30 years. Facing night shifts, lawsuits, responsibilities, surgeries. Spending sleepless nights, giving up weekends, taking expensive courses, dealing with constant pressure. All of that just to secure safety, stability, and maybe, one day, a peaceful retirement. Now, imagine that all of it, all that effort, can be put at risk not because of something you did, but because of a ticking time bomb that's about to explode at the heart of the global financial system, the U.S. Treasury bond market. Yes, that investment that's always been sold as the safest in the world. In this video, I'm going to show you why this market is on the brink of a silent collapse, how this could directly impact your wealth, even if it's invested right here in Brazil, and most importantly, what you can do, starting now, to protect everything you've worked so hard to build. So go ahead and hit the like button, because this content could literally save your financial future, and make sure to subscribe so you don't miss any of the upcoming videos. Here, we talk about money like no one ever has with you before. Most people who invest have never questioned the foundation of the system. After all, for decades, U.S. Treasury bonds were considered fail-proof. They were the solid rock where banks, funds, governments, and investors placed their money to keep it safe. But every structure, no matter how solid it looks, can collapse when the foundation starts to crack. And that's exactly what's happening. Since 2020, the United States has printed trillions of dollars to save the economy during the pandemic. The result? Public debt skyrocketed. Today, it exceeds $34 trillion, and just the interest payments already consume a massive portion of the federal budget. It's like a dentist who earns a good salary but takes on so much debt that his income barely covers the bills. He starts selling assets, then refinances the debt, then takes out another loan, until one day, the whole house of cards collapses. That's the scenario unfolding out there, and if you think this is just economist talk, or that it has nothing to do with you, you're about to get a reality check. To better understand this, think about the following. When interest rates go up, older bonds lose value. Why? Because no one wants a bond that pays 1% per year if they can buy another one that pays 5%. It's that simple. And do you know what's happened in recent months? The Federal Reserve, the U.S. central bank, raised interest rates faster than at any other point in recent history. The result? Trillions of dollars in bonds have lost value. Just in 2023, dozens of regional banks in the U.S. collapsed. Do you know why? Because they were stuffed with these devalued bonds. The scariest part? Many pension funds, including Brazilian ones, are also exposed. Even that conservative fund in your VGBL plan, that fixed income fund at your bank, or that portfolio managed by a specialist who never really explained where your money is being invested. And here's where it gets truly dangerous. The more bonds lose value, the more confidence the system loses. And when confidence disappears, collapse doesn't announce itself. It just happens. Now you might be thinking, okay, but what does this have to do with me? The answer is, everything. Because if you're a doctor, a lawyer, a dentist, you don't have the time to study the market deeply. You delegate. You trust. And often, you trust exactly the institutions that are buying those same bonds right now, as if nothing's happening. It's like a surgeon operating with faulty equipment, but no one tells him. One mistake can cost lives. And when it comes to your money, it can cost your dreams. The beach house. The kids' school. Your independence. Your time. That's why, if this video is making sense to you, stop for a second and hit the like button. This tells YouTube that this content needs to reach more people like you, people who work hard, but could lose everything by blindly trusting so-called safe investments. For a long time, U.S. Treasury bonds were seen as a safe haven, a kind of unbreakable vault where investors could store their money and sleep peacefully. But that narrative hides a dangerous truth. There is no such thing as zero risk in any market that depends on confidence. And confidence is an intangible, fragile asset that can evaporate overnight. Imagine you lend money to someone based on their reputation, not on real guarantees. Now imagine that person keeps asking for more money, promising to pay later, and the size of the debt grows so much that no one really knows if they can pay it back. That's exactly what's happening with the U.S. government. The perception of safety is being eroded, slowly. The real risk isn't an immediate default, but the meltdown of asset values due to widespread distrust. And when the majority wakes up to this reality, it'll be too late. If you already understand what's at stake, Go ahead and hit like, and let's keep going together. The U.S. public debt is a silent bubble that's grown, fed by political promises, endless wars, and trillion-dollar stimulus packages. In 2020 alone, when the pandemic began, the U.S. government injected over $6 trillion into the economy. Sounds like a lot. That's because it is. And that money didn't come from a public savings account, it came from money printing. With every new social program, new subsidy, new international aid, the government borrows more. Today, the U.S. pays hundreds of billions of dollars in interest alone each year. This means that a significant part of the taxes paid by citizens is used just to keep the debt running, not to invest in health, education, or infrastructure. This model is unsustainable in the long run. And if your wealth is tied to this system, you're holding a grenade without knowing if the pin's already been pulled. Many people celebrated when the Fed raised interest rates to curb inflation. But this has an explosive side effect. The higher the interest rates, the harder it becomes for the U.S. government to roll over its debt. Every new bond issued has to offer a higher return, which increases the debt cost even more. This is a vicious cycle. Imagine a lawyer trying to get out of credit card debt by taking a new loan at an even higher rate. That's what the U.S. is doing. On top of that, high interest rates reduce investors' appetite for risk, which impacts the market as a whole, including in Brazil. More conservative funds become overloaded with securities that seem promising in the short term, but hide structural traps. And who ends up paying the price? You, who often don't even know where your money is really invested. That's why, if this content sparked something in you, hit subscribe. The truth needs to be told. For over 70 years, the U.S. dollar has held the position of the world's reserve currency. However, this dominance is now facing unprecedented challenges. Nations like China, Russia, Brazil, and others are actively seeking alternatives for bilateral transactions, opting to use their local currencies instead. The development of new financial infrastructures, such as China's cross-border interbank payment system, CIPS, which serves as an alternative to the SWIFT system, indicates that the dollar's hegemony may be waning. If global trust in the dollar as a store of value diminishes, the demand for U.S. Treasury securities could decline, leading to a drop in their prices. This scenario could have far-reaching effects, impacting large pension funds and even individual investors who have invested in products tied to international securities. Such a silent shift has the potential to destabilize financial systems without any overt conflict. Staying informed is crucial to navigate these changes effectively. A significant yet often overlooked development is China's gradual reduction of its substantial holdings in U.S. Treasury bonds. This move is not merely a technical adjustment, but is deeply rooted in geopolitical strategy. Amid escalating trade tensions and a global competition for influence, China aims to lessen its vulnerability to the U.S.-dominated financial system. By selling off billions in Treasury securities, China exerts downward pressure on their prices and upward pressure on yields, thereby introducing additional strain on the system. This action sends a clear message. China no longer has unwavering confidence in the sustainability of U.S. debt. If the world's second-largest economy is divesting from these assets, it raises questions about their perceived safety. You might think, my investments are based in Brazil, this doesn't concern me. But consider this, numerous local funds, including pension plans, have direct or indirect exposure to U.S. securities. Moreover, banks and major asset managers often deal with derivatives and structured products linked to U.S. debt. In the event of a collapse or significant devaluation, the repercussions could cascade through the financial system, much like a distant earthquake triggering a tsunami. You don't need to be at the epicenter to feel the impact. Therefore, it's imperative to critically assess your investment portfolio. Inquire, investigate, and challenge the status quo. Financial resilience begins with awareness. U.S. inflation has global ramifications. When the dollar's purchasing power declines, commodity prices worldwide tend to rise, directly affecting emerging markets like Brazil. This influence extends from fuel costs to basic food items like wheat. Additionally, the U.S. response to inflation, raising interest rates, attracts foreign capital, leading to a depreciation of the Brazilian real. This depreciation makes international travel, imported goods, and even the operational costs of clinics and offices reliant on foreign equipment more expensive. These subtle shifts may not be immediately evident in bank statements but gradually erode purchasing power. Being vigilant about these trends is not just sound financial practice, it's essential for economic survival. Investors often place their trust not in specific products but in the confidence that underpins them. The U.S. Treasury market, despite attracting billions, is heavily reliant on the belief that the government always pays its debts. However, this confidence is fragile. A crisis of credibility, a government shutdown, or a downgrade by rating agencies can quickly erode this trust. When confidence dissipates, there's little time to react. Liquidity dries up, prices plummet, and panic ensues. Trust functions like oxygen. Its absence is only felt when it's gone. Consequently, major investors often exit at the first sign of trouble, leaving the average investor, the one most in need of protection, exposed. Many economists still regard U.S. Treasuries as risk-free assets, reflecting an outdated perspective of the financial system. Their analyses often rely on obsolete models that fail to account for modern market dynamics, such as network effects, rapid information dissemination, and the emotional behavior of investors. Today's economy resembles a complex ecosystem more than a predictable machine. Minor imbalances can trigger significant reactions. Blindly trusting official forecasts can be as hazardous as driving while only looking in the rearview mirror. It's crucial to recognize early warning signs ahead of the broader market. Staying proactive and informed is key to navigating these uncertainties. As traditional financial systems show signs of strain, a new financial architecture is emerging, one that is decentralized, transparent, and resistant to censorship. The rise of cryptocurrencies, the advancement of asset tokenization, and the exploration of central bank digital currencies, CBDCs, indicate a shift in the monetary landscape. This transformation won't happen overnight, but it's inevitable. Understanding and adapting to this new environment early on provides a strategic advantage. It's not about abandoning the current system, but about intelligently diversifying into this evolving space with a strategic, cautious, and long-term approach. Faced with a deluge of information, it's natural to feel overwhelmed. However, inaction is the greatest risk. Financial procrastination is a sophisticated form of self-sabotage. Each day spent without reviewing investments, questioning decisions, or seeking knowledge increases vulnerability. The reality is straightforward. No one will safeguard your financial future better than you. If this message resonates, share it with others who need to hear it. Knowledge becomes transformative only when it's disseminated. Ultimately, this discussion isn't solely about the potential collapse of U.S. Treasuries. It's about reclaiming financial autonomy. It's about taking genuine control of your financial life. Regardless of when you start, feeling lost, or lacking numerical acumen, the crucial point is recognizing the need for change. Blind trust in the system is no longer viable. Now is the time to become the protagonist of your financial narrative. This awakening marks the beginning of a new chapter, one characterized by awareness, strategy, and intelligent decision-making. Let's embark on this journey together. But don't worry, not all news is bleak. The advantage of understanding these dynamics now is that there's still time to act. The first step is to do what few consider: ask questions. Inquire about the specific assets your private pension is invested in. Demand transparency. While some managers may obfuscate with jargon, you have the right to know if your future is tied to unstable assets. Next, begin diversifying intelligently. This doesn't mean hastily investing in Bitcoin or purchasing gold bars. Instead, build a resilient portfolio capable of withstanding shocks. Include tangible assets like well-located, liquid real estate investment funds backed by physical assets, a portion in precious metals, and a strategic, modest exposure to digital assets, which are increasingly seen as alternatives to governmental monetary instability. Warren Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." And the tide is receding rapidly. The coming years will distinguish those who understand the financial landscape from those swept away by it. While the U.S. Treasury market may not implode suddenly, it's already quietly eroding the wealth of those who believed in its perpetual safety. If you've read this far, you're already ahead of the curve. You've taken the most critical step, seeking knowledge. Now, it's time to take action. Stay informed, remain vigilant, and continue to educate yourself on protecting and growing your wealth with intelligence, awareness, and freedom. You don't need to become a financial expert, but you must take the wheel of your financial journey. No one else will do it for you. In today's world, information isn't just power, it's protection. It's the key to ensuring that your hard work isn't undermined by a flawed system. So, reflect, question, and, most importantly, start now. There's still time, and you deserve to reap the rewards of your efforts, with security, autonomy, and peace of mind. Let's move forward together.